Hey guys, TommyBryson here, and welcome back to our long-term team book club where we actually take a look at books and we basically break them down. And this is video or book 71 in this series. Now, so far I've read well over 200 plus books, but what I love about doing this is basically we actually get to look at a book, look at all the information, get the core concept out, and basically I give you that thesis here in this video. Now, in this video, we're actually taking a look at the Depression Diaries by Benjamin Roth, and this is actually an author. He spends literally almost 5 decades recording journal entries about the Great Depression and everything that happened during this time. Now, I can almost make you a promise, and it's basically that by the time you're done watching this video, it is going to change the way you invest forever. Because what this video and also what this book intends to do is put the fear of God in you when it comes to investing. So you actually know how risky of a business investing actually is. We don't want to make it look like, hey, everything is good all the time. No, it is risky. You could lose everything and it could be bad for a long time. So you don't know how crazy investing is until you're actually living as an investor for a few decades, okay? And it's well worth it. I recommend you invest 100%, but you have to watch this video so you understand everything when it comes to investing. And that's why I've broken up this video into 3 core concepts, and that's going to be the boom, the crash, and then finally the lessons I took away from this book. Now, let's dive right into it. Now, the boom is an era where the economy almost feels like it's just going to keep going up and up forever. That everything that you put your hands in is just going to turn into gold. Now, in this book, we actually see the Roaring 20s, which happened from 1920 to 1929, but it started right after the World War I ended, which was basically in 1918. Now, in the book, the author actually mentions a couple just so you guys can actually see how far this prosperity actually went. So here is what the author basically says. Story is told of a young couple who used the following plan. Started investing in 1915, they regularly saved 10% of their earnings and little by little bought sound common stocks. They never speculated or sold and knew nothing about the stock market. In 15 years, an original investment of $5,000 was worth $100,000 because of dividends, split ups, etc. The original stock. This seems to be the sound rule for obtaining wealth, but it requires patience, which few possesses. Live on less than you earn. Save at least 10%, invest, don't speculate so that none of the principal is lost, reinvest the earnings, never sell a good stock unless the price is above intrinsic value as of 1929. Now, I know what you're thinking. Tommy, a $5,000 investment turning into, for example, $100,000 is impressive, but it's not really gonna make you rich. It's not going to make you wealthy. Now, just for perspective, $5,000 in then's money would be the equivalent of $92,000 worth of today's money, and $100,000 back then would be the equivalent of just about $1.8 million. So what I'm trying to tell you guys is, imagine investing $90,000 over 15 years and then getting $1.8 million. I mean, that's enough money for your entire life to actually change. Now, for some even greater perspective, you might say, Tommy, I didn't live during that time, so I can't really tell you how it actually feels. Well, I know how it feels, and you also should know how it feels, because during 2020, we had a massive pandemic where the stock market actually went down. And what's actually interesting is that after 1918, when the World War actually ended, we had a small recession, but then we had a massive boom. Just like when we had the entire pandemic, we had a small recession, but then we had a massive boom. Now, what I did was during this time, I invested some money into a company called Delta. And I invested around like $14,000, and when I sold and I made about $28,000. I basically 2x my money, which by the way is nothing compared to this, because I could have made, for example, 6x. But during that time when we had that massive boom, it almost felt like absolutely everyone was just talking about stocks online. Everyone was just so excited about investing, and everyone was basically gamifying investing, but also romanticizing investing. Now, I'm telling you this story because I want you to understand what a boom period actually looks like in the economy. It looks like this, okay? Everyone seems to be making money. Everyone seems to be just investing in the stock market, and everyone thinks they're going to be rich. But obviously, that's only the first part of this book, right? It's the boom, but then follows the crash. And here's what happened. And I want to remind you that the purpose of this video and the purpose of this book is just to put a little fear in you when it comes to the stock market. So that way you can change the way you approach investing. Not because I don't want you to invest, but because I want you to know all the facts and the reality when it comes to investing. Now, this book is basically just filled to the brim with a lot of depression stories, okay? Not depressive stories, although they are depressive, but just depression stories that basically took place during the Great Depression of people that actually had a lot of money and then lost everything. But I picked one specifically that I found to be super interesting, and I'm going to break it down little by little so you actually get the whole picture. I'm just gonna shut up and read this, and here's what it says. From time to time, people tell me experiences in the stock market. For the most part, they were within reach of large profits but did not take them. Dr. SD said, in 1929, I held $180,000 in the stock, subject to a 40% margin. The crash caught me and I rushed in to sell, but my broker strongly advised against it. Later, I had to put up $10,000 in additional margin. I finally sold out in 1930 and salvaged only the $10,000 margin. I put this $10,000 in a home savings bank. It closed in 1931. In 1932, when the market was at low ebb, I sold my passbook in the home savings for $4,000 and bought high-grade stocks at about 1/10 their value. I determined to hold these until the market came to normal. I did hold on until the first part of 1935, but then I needed the money so badly, I sold these stocks for about $10,000. 6 months later, these stocks shot up high, and I would have made an extra $50,000 if I had just been able to hold on. Just for perspective here, guys, $180,000 is the equivalent of $3.3 million. It is enough money to secure an income for your lifetime, for your old age. Just an absolutely incredible amount of money. I mean, off of $3 million, you're probably talking about maybe like $120,000 a year without that much risk, just by taking out 4% of the principal every single year. Here's what I want to tell you. First of all, we see that this guy in the story, he has 180K, 3.3 million, enough money for a lifetime, but he decides he's going to keep this money in here. When it actually crashes and is actually going down, he goes to a professional. The professional tells him, hey, don't do it, don't sell. Now guess what? In investments, professionals, honestly, their opinion doesn't really matter that much. You have to do your own thinking when it comes to investing. And that's why this video is so important, because yes, I'm a professional when it comes to stocks and investing. I've invested a lot of money. I've been doing this for a while, but when it comes down to making a decision, you should not be waiting on me. You should be thinking for yourself, and you should make your own decisions based on the data you actually have. Now, obviously, this guy was basically borrowing money. That's why he had a margin account. A margin account is basically when you have a certain amount of money, you borrow money against your stocks from the broker usually, and then if the value of your stocks falls below, in this case 40%, then they can literally go ahead and sell all your investments to make up that loan, or you have to put up more money. Guess what? He literally walked away with just $10,000, basically saying the guy was wiped out. Now, here's where things get kind of crazy, okay? Because you've never seen this before. He put his money in a savings account. We all do that, right? We all most likely have savings accounts. Now here's what happened. That savings bank basically closed. We have not seen that, right? We've never seen a bank crash because we have, for example, FDIC insurance, and we think that banks are never going to fail. But I don't think that basically saying that, hey, we do have FDIC insurance, which is covered by the government in a way, but If that were to ever happen and we were to put that to the test where just multiple banks basically fail and crash and the government has to print a lot of money, trust me, you will get your money back most likely, but it will not have the amount of value it had before. It will not be worth what it was worth before. Not just that, but when the bank closes, he has a passbook, which is basically his account. Now, back during this time period, people were actually buying these accounts off other people for a discount. It's like saying, hey, my bank closed, I had $10,000 in there, here's the book. If you want to buy this account from me and take the risk of actually getting the money when the bank opens up, if it does open, I'll sell it to you with a discount. So he basically sells it for $4,000. He buys stocks at 1/10 their value, and his intention is, I'm going to hold, and most likely his intention is, I'm going to make my money back. But here's what no one ever thinks about. Everyone always thinks that, well, you're just going to invest and you're going to be able to hold, but it shows a different picture. Obviously, life gets in the way. You have emergencies, and during these times of massive depression, guess what? You may not have a job. You may not be able to put money on the table. You may just be hungry. You may just be desperate. You need to pay the bills. You need to take care of the family. So when that happens, he's forced to sell. He only gets back $10,000. By the way, it's still a good chunk of money. Remember, that's about $184,000, if I'm not mistaken. But he basically leaves on the table a bunch of more money because 6 months later, the stock market actually goes up. Now, the lesson you can take away from this, I'm going to tell you later in this video, but the point is, I want to put the fear of God in your soul. I want you to know that if you invest your money in the stock market, there can come a period where you basically lose 90 to 80% of all your value. And when you're forced to sell and you put your money in the bank can crash. You can spend a large amount of time trying to get your money back. When you get the money back from the bank, the money you actually get is not worthwhile. And even if you put the money back, if you needed that money, you could be forced out of it again. Investing is a risky business. I want you to get that. In this book, you will find countless stories of people that actually happened to, but not just, for example, someone losing money and then getting part of it and then making some of it, but there's also stories of people that lost everything and they basically did not come back home because they just decided to do something that they shouldn't have done. You have stories of people that lost everything and that caused them to get illness, they got heart attacks and did not make it back home. So it can be tragic. It can be awful. It can be very risky. Here's what a stockbroker with 40 years of experience actually laid out in the book to the author. And he said, a stockbroker after 40 years of experience said to me today, the only people I know who ever made money in the stock market are those who bought for cash and owned the stocks outright. I do not recall a single margin trader who did not lose sooner or later. And what's so attractive about a margin account? Well, I'll tell you, okay? Let's say I have $100,000 invested and the broker says, we'll give you $50,000. I can basically buy stocks with that money, and if that stock goes up, I can make basically double my money and pay back them and then keep the rest of the profits. I mean, that is awesome. But the problem is that if my $100,000 portfolio goes down in value and now they're like, hey, we need to sell all your stocks. We're going to liquidate you just so we can get back our $50,000, okay? That can happen. Whenever you take on extra risk, you can lose everything. And notice what it says here, okay? In 40 years of experience, everyone always thinks that, hey, I heard about this guy that made a lot of money, but what about in 10 years or 15 years? Is that person still going to be making money? That's the question. Is that their best game plan? Now, just to put in a little bit more fear in you, I want to show or just label a few of the things that actually happened, okay? So you had the war just ended in 1918, World War I. But then you had the Roaring 20s, which is basically the boom. 1929, you actually had the Great Depression, and it took over 20 years for the market to actually recover. Now, just for perspective, if you're 25 years old right now and you're watching this video, you will be 45 years old when you actually recover the money that you actually invested in the stock market. I mean, that's crazy. That's how long this can actually go for. On top of that, during that time, you also had World War I, And you also have the draft, where people between the age of 21 to 35 or 45 were actually forced into war. And that was World War II. And by the way, when you read about World War II in this book, it kind of shows you how close the world was of being a different world. Because if Germany had won the war, Hitler during that time period, by the way, this whole country would have just been a lot more different. Again, I really want to scare you, but not because I don't want you to invest, but just because I want you to know what investing and the risk is actually all about. I want you to have all the facts. Now, I want you to also know that we also had inflation during this time. We also had massive bank failure, not just bank failure like banks failed. No, like banks closed and people never got their money back. Life savings basically erased overnight. People that had farms, they lost their farms. People that had a real estate, they lost their real estate. People that had businesses without any customers, guess what? No customers, no sales, no business. You have real estate, no tenants, no payments, you can't pay taxes, it gets defaulted, you're done for, okay? So it's not just the people in the stock market. I want you to imagine what a crippled economy is actually like, because that's what actually can happen. And when you picture that in your mind, you will not invest as aggressive as most people do when they romanticize investing. I'll take risks with this, I'll take risks with that, because at the end, you really want to preserve your capital. Now, one of the craziest parts about this book is that you're reading it, and this is the author, and he has, for example, 50 years worth of journal entries recording everything that's actually happening. And the author never got a chance, in my understanding, during the time period of the book, to actually even invest in the stock market. Because although there were a lot of opportunities during this time, he had no money at all. And this guy was a lawyer, and his law practice was getting absolutely no action. And he had to pay for college for his kids and so on, and have the bills and all this stuff. So again, when times comes, when times get really bad, you may have a lot of opportunities, but if you have no cash, you're also done for. Even the author couldn't take advantage of it. The lesson here is incredible, and it's enough to actually change your way when it comes to investing, and it could actually save you a ton of money. So I strongly recommend you give this book a read, because you get to live through something that you never will live through, most likely, maybe, hopefully, but it'll change the way you invest forever, and that can make you a lot of money, and it could also save you from a lot of headaches and a lot of failures in the future. But Benjamin Roth, he says something that I actually want to read here, which is basically his concluding lesson in a way. And here's what it says: "The more I see of the recent stock market slump, the more I'm impressed with the fact that the American people look upon the stock market as a piece to gamble and not to invest. In times of rising markets, the average American becomes over-optimistic. He invests his whole capital in common stocks of the most speculative variety." I mean, you saw that, right? During the entire pandemic, people were just basically just dumping their small life savings of 10,000, 5,000, 1,000, which is still money that they worked for, and they were basically dumping it into crypto and into a bunch of things that they did not have any experience or any business actually investing. It is gambling. Often extends themselves on margin. Then when a slump comes, he finds himself overextended. No cash reserves to fall back upon. He becomes unduly pessimistic and sells at a loss. The European investor takes his capital, no matter how small. Half he invests in government bonds, 25% in high-grade dividend-paying stocks, and the remaining 25% he will use to gamble on speculative stocks, offering the possibility of large gains. Basically saying, at least the European actually has a balance. He puts money into bonds, money into good stocks, and then some of it he puts it to speculative nature, but he has some of the capital that's actually secured. In the long run, he comes out best. His possibility of loss is limited, and an abnormally low market like in the 1932, he has the capital for unusual bargains. What the American needs is not only stock exchange regulation, but also an education on investing possibilities of the stock market. I always thought that bonds were just garbage and not worth it, but when things actually get hard and tough, those bonds are going to be there. Now, when stocks get really cheap, usually bonds get attractive. That's just how the game works. So So during the time period when you actually have a crash, if you had bonds, you're able to sell those and you're able to buy stocks at an attractive price. It's not like saying, for example, you know what's going to fix the economy, you know what's going to fix the stock market, you know what's going to fix investors' life. It's going to be regulation, more rules, and more government involvement. The answer is no. It's going to be education. Us as Americans being educated on what it actually takes to be an investor. Now, I continue here. The average man who buys real estate for investments makes a careful study of the property, the location, the income, etc., and hires a lawyer to examine the title. He then expends a lot of time and energy to collect rents, make repairs, etc. At the end of the 10 years, if he can say that his investment shows an annual return of 6% and then a reasonable capital profit when he sells, then he will consider that investment a success. I mean, that's so true, right? When people invest into real estate, they know there's going to be costs. They know they need to make money when they actually buy, and they know that it's going to be slow but steady, and hopefully they're going to do a good analysis. But when it comes to stocks, it's not that. It's that, hey, I think it's going to go up to the moon. We don't have the same attitude. We don't know anything about what we're actually doing, and we don't even do any research, which is actually terrible, and that's why people gamble and lose everything they actually have. That same man, when he buys stocks, either will not investigate because he does not know how, or because he is lazy. He bets his money as in a horse race and does not feel his venture a success unless his money is doubled in a very short time. In the participating and care used in the real estate investment were used in making a stock investment, there will be much greater chance of success. We just expect to make double, triple, quadruple, 6x, 10x our money when it comes to stocks, but we all know that that's usually not going to be possible. And the investments that actually can give you that opportunity, they're not going to follow the first rule of investing, which is basically make sure you don't lose your capital. You have to preserve your capital by all means because your capital is your tool as an investor. Here's my advice from me to you when it comes to investing and how I would actually go about it. In the end, you should give this book a read for sure. It's 100% worth it. The way I would actually go about it is try to have no debt, no consumer debt whatsoever, no student loan debt whatsoever. Just have no debt except the mortgage. Try to save 6 months to 12 months worth of emergency funds. And you might say, Tommy, why 12 months now? When you read this book and you see how crazy things can get, I would say start with 3 to 6 months, yes. And then invest 10%. Make it a habit to invest 10%. With the surplus money that you actually have after investing 10%, use that to purchase a home and to try to pay it off as fast as possible so you actually own it. Because what I've realized is that when it comes to investing and the nature of it and the nature of economies, when the economy crashes, the government tries to get involved and control it and usually ends up just making everything worse. The best position you can be in as an individual, as a citizen, is going to be have no leverage in the sense that you have no debt, nothing to worry about in the sense, have an emergency fund so if you lose your job, you can be okay, and then making investments. But once you have a home that's actually yours, your cost of living is so low that you don't have to worry that much about anything. And that's why today I only invest into low cost index funds like the S&P 500. I have some cash to buy a home and purchase it in cash if I actually wanted to. And I keep my living expenses well below my means. That way I don't live an over leveraged life. So if something were to go wrong, I'll be just fine. Some mistakes that I noticed I was about to make and I didn't make and I got very lucky is that sometimes you take on way too risks. When I made that Delta investment back then, I could have kept going, but it's very important that when you get lucky and you notice it, sell everything, take the profits, and walk away. Because it was just luck. And if you keep playing that game, you're going to end up losing everything you have. You'll lose your pants. I've also noticed that sometimes we get a little bit too excited about something. So if I'm excited about land and real estate, I may just go ahead and put all my money in some land, some real estate, and that's also going to be a terrible investment because it's not going to give you a good return. If you're putting all your eggs into that one basket, you could end up basically financially crippling yourself forever. But guys, that is it for this video. Thanks for watching, and I highly recommend you actually read this book again, Depression Diaries by Benjamin Roth. What a great book this was. And I did notice something about the author that he never had money to invest, but I did see in the introduction preface that he actually bought a new car during that time, and he was putting his daughter through college. So I do think that for the most part, he could have probably found a way to invest during that time and made a good amount of money. Thanks for watching. Subscribe to the channel. Like this video for more videos like this. And I'll see you guys next time on the next book review. Peace.